Hi there, happy Earth Day, April 22nd. It's my friend Holly's birthday. Wanted to do an update for you today, and I want to applaud you for being here, for watching this, because there's a lot of noise out there that we shouldn't be thinking about money or the economy. We should only be concerned about death and disease. And I disagree completely. Little editorializing here, and I'm not agreeing with those who are saying just fling the doors open and let's hope for the best. Not saying that at all, but what I am saying, I do feel very strongly that simultaneously with the health issues, we need to be addressing the financial and economic aspects as well. And I think a lot of people are doing that. One thing that gets left out of the discussion: financial stress can have major effects on health. Stress in general can cause heart attacks, strokes, other serious health issues. And don't forget, it's some of these underlying health issues that are causing people to, unfortunately, pass away from COVID-19. So financial stress absolutely affects work, relationships, money, health, everything. Okay, so one thing I've always done for the past 20 years is to help put market news in context. And I want to address, again, some of the comments going around on the interwebs, just about markets in general. Yes, there is a disconnect between Wall Street and Main Street. Nobody is more aware of that than I am. And for what it's worth, many big institutional investors do also understand this. I think that's important for retirement savers to know. The reason behind the stock and bond markets that are important. So contrary to what you might hear out there, it's not just the uber wealthy who are invested in the stock market. If you have a 401k or an IRA or some retirement account, even with a past employer, you are invested in the market. So what's going on right now with the oil prices, and I'll talk about that a little more later in the week, with everything going on, it does apply to a lot more people than you might realize. So let's take a look at the charts here. I like to start with the S&P 500, not because I consider it the benchmark. That's a big misnomer. But it is familiar, and you hear about it in the media a lot. So let's take a look. So there's a lot of talk in the mainstream financial media asking, has the S&P 500 hit bottom on this particular pullback? And you can see right over there where we are right now. And this is on a monthly chart. And the reason I'm showing you a monthly chart is because I want to go back to this period of time starting in right over here in 2000, when the market began to pull back in the fall of 2000. Okay. And I was reading some quotes from a hedge fund manager named Howard Marks, very accomplished investor. His viewpoint is worth listening to. Now, he made an obvious point here that you don't even need to be a hedge fund manager to understand. And he was making the point that it took 7 years for the market to retain its 2000 peak. And you could see that right there. Okay, it took 7 years for that to happen. Then again, right after it regained that peak, what happened? Tumbled again began in the fall of 2007, as many of us well recall. Okay, what happened at that point, though, was it took another 5.5 years. It was somewhere right in here around early 2013 before it regained that level of 1576 again in the S&P 500. So what's the reason I'm telling you these comments from Howard Marks? Because he's making a great point. For those who are saying, hey, we've rebounded, the market's coming back, there is still way, way, way too much uncertainty right now with coronavirus, with the economy, with the job losses, with the government stimulus. Way too much we don't know, not just here in the United States, but in the world. Nobody can predict the fact that we've rebounded and it's all going to be good from here, smooth sailing. A lot more damage that could occur. Now, I'm not saying this to be a negative Nelly, not at all. The reason I just want you to know this is so you put the actual decline in perspective, and I want to do that too. Right now, we are about 17% off of this high right over here. I switched over to a daily chart right here, by the way. We're about 17% off the prior high from February. By the way, that was the S&P 500's all-time high. And you do see, if you go back, right? We rally to all-time highs, pull back, all-time highs, pull back. Now this time, between 2013 and 2020, it was quite trajectory higher there before pulling back again. I just want you to keep this in context, though. Let me go back to a weekly chart. You know, you're hearing the term from people that are not students of the market who are saying things like, we're in a depression era correction. That is just not true, and I can't say this enough. We are down 17% from the high. Again, no predictions over what's going to happen here. None of us know. Be prepared for more pullbacks, but if you really want to talk about depression era, then you need to know over a 3-year period between 29 and 32, the market pulled back 90%. Okay? We're nowhere near that yet. I do see possibility for further declines. I want to go back to a monthly. And you do see here, we have managed to keep the floor over here and not fall past this 2016 low. So far, so good. We did pull past the 2018 low and rebounded. I'm still watching this over here, this floor of about 1810. To see if the S&P 500 does end up pulling back that far. Wouldn't surprise me if it did, perhaps even further, but I am still looking at this to see if that's any kind of floor. Okay, that was what I wanted to let you know today. Thanks again for watching. I am going to take a look at some of the sectors, in particular oil. That's getting pretty interesting, so that will be my next video. Thanks again. Have a great day. Stay safe.